What's up, guys? Welcome back to DCA. So what we're going to do in today's video is take a look at this new risk metric that I've created. So this one's going to be a little bit different than anything I've released on the channel before, and I think it's going to tell you what's going on in the underlying market. What are the fundamentals of the crypto market, and more importantly, of Bitcoin? Because as we know, as we've discussed many times on the channel, even if you're only interested in altcoins, understanding the dynamics of Bitcoin are going to be important to you because it drives the entire market. Now, Ethereum is increasingly taking a similar type of role as Bitcoin, but still, the number of active addresses daily on Bitcoin far outweigh those of Ethereum. So we're going to look at those metrics today, and we're going to understand this new risk metric that I've created and how this can help you improve your overall investment strategy. So with that said, if you guys like this type of content, even if it's just for all the free metrics that I've released, the DCA index, the numerous different trading view scripts, if you guys could just go down and hit that like button, it really drives the channel forward, guys. So with that said, let's get into it. We have the price of Bitcoin. We'll just quickly review where we're at right now. We just trended sideways all through November, all the way into January, sitting at right around 17K. And in the last video, we showed how there was a large amount of Bitcoin buying at that level. In fact, more than you would normally see. And so we suggested in February and in January that, this could have been the move where the whales stepped in, bought Bitcoin, and have now formed that floor of this particular bear market that we've seen ever since November of 2021. Okay, guys, so what I've added here is the total dominance of USDT and USDC. So what that means is this is going to be the market cap of those two assets divided by the total crypto market cap, right? And so that's going to give us 0.1 or 10%. Okay, so this interesting trend has started to develop with these two metrics. Notice that in each case, and I'll just draw a vertical line here. In each case, when we come up and touch this upper band here, notice the price of Bitcoin is rather depressed in each of these cases. So we're talking like here, and we're talking, remember, points where we're hitting this green band, right? And in each of these cases, we're seeing that the price of Bitcoin is rather depressed. After coming down and touching this band in each case, notice what's happened. We've went on a rather significant price rally. Back here in February of 2019, we ran up to around 12K, starting at around 3K. We had the COVID capitulation event where we went from around 5K and we got all the way very rapidly up to around 13K. All right. And so you see this trend play out throughout the entire history of Bitcoin. Now, conversely, what happens when the market cap dominance of USDT and USDC comes down and hits this lower band, right? So that means the value of assets is very high with relation to the value of all the dollars in terms of stablecoins sitting on the sidelines. And these tend to be price peak zones. And you've seen that here, again, here as we came down and crashed into the COVID capitulation. We saw it all through the end of 2020 into 2021 during this bull market. We saw it again in November, and we're kind of at that level now. So the reasons for this make sense. And that's simply that when the value of dollars sitting on the sideline is much higher than the value, or not necessarily higher, but when it's higher in relation to the value of assets, those dollars can drive price farther. Conversely, when the value of assets is much higher than the dollar sitting on the sideline, it's more likely that selling is going to then rapidly drive that price down and then drive the value of dollars sitting on the sideline up with relation to those assets as the price is falling. Okay. So the concept behind this is very sound and, it makes a lot of sense. But we have to think, market cap dominance can't rise forever. So we need a different way to think about this because eventually this isn't going to hold anymore. It can't hold forever, simply for the fact that market cap dominance is capped at 100. And if you get to 100, that means all value is in stablecoins and none of the value is in crypto assets. So this simply can't hold forever. So we need a different way to think about this. And so that's how this metric has started to come about. And, as far as I know, this is something no one else has, kind of talked about. the inherent flaws in the fact that we're using a linear trend line in order to identify where this metric is going to be in the future. But I think we can even do better than that, because the dollars on the sideline, understanding that, that's fine. But combining that with the most fundamental metric that we have, which is the number of users, the number of active addresses, how many people are actually transacting on the asset. Understanding that in conjunction with this metric, I think we really come up with something unique. And so that's what we're going to explore next. Okay, so here again, we have the price of Bitcoin, and now we have the active addresses for Bitcoin. And I'm not going to spend a bunch of time talking about this because it's a very basic and understandable concept. As your active addresses are rising, that means there's more investors. There are, simply put, more investors out there willing to participate in the network or at least trade the asset. And so, in other words, that's increased liquidity. When we have more liquidity, there tends to be a rise in prices. Less liquidity, like you saw all through 2022, means a fall in prices. And so, this is very obvious here. As this is rising, we tend to see a rise in price, right? As it falls, we tend to see a fall in price. So we saw a large drop in the number of active addresses right here in June of 2019. And what happened? We saw a coinciding fall in price. Once this started to rise, we saw again a rise in price. All right. Now this rose all through 2020 and then eventually into 2021, where we hit this peak. And you'll notice this large spike here. So we had this trailing active addresses where people were leaving. They weren't buying Bitcoin anymore because they were trying to get into altcoins. This is that altcoin mania. And you could almost just use this metric to see, hey, the price of Bitcoin is still up here at nearly 60K, but the active addresses are plummeting. That must mean people are moving to altcoins. And sure enough, that's exactly what happened, because that's how money flows in this market. It goes from Bitcoin to Ethereum, then to the altcoins. And that still remains true. You still see primary money coming to Bitcoin, even though there are more Ethereum investors overall now. You see the money moving to Bitcoin first, the big money moving to Bitcoin, then it goes to Ethereum, and then finally it kind of moves into that altcoin market. Now, that's all becoming compressed as we go forward. We've seen more of a situation where there's less disparity in the timing between these metrics than we've seen in the past. And I think that's going to continue to sort of compress down. And that's why understanding Bitcoin at any given time is important. Even if you are only concerned about altcoins, having that knowledge of where Bitcoin is at is really going to help you, because if the timing is decreasing, you're not going to have that giant lead time anymore like you used to have in that past, where we got to watch Bitcoin go on a run for 3 months before the altcoins went on their run. Now it's all going to happen, and it's going to happen quickly. So understanding where the market's at any given time is going to be critical to an investor. Okay, so now we have our risk metric, and it has this orange upper band and this green lower band. So let's just go ahead and hide the inner part here. And what this is doing is taking the combination of, using various mathematical techniques that I'm not going to dive into in this video. It's just understanding what the metric is doing that's important. But they take these two metrics and they're essentially defining a range for them and saying, based on everything we know about these data points, when this type of change occurs here or that type of change occurs there, we would expect the price to fall somewhere between this range. All right. And so we're normalizing movements in the price in order to fit within these ranges. And so when the price is oscillating between this channel, that means everything's kind of as expected. We haven't seen a massive price run that's out of line with what we're seeing with the two metrics, so the active addresses or the stablecoin dominance. Price move matches that. So what might be an example of that? Let's just come up with a theoretical example. As we're going on this huge price run in January, are the active addresses matching that based on historical data, based on what the data is telling the model? The model says, if we see a huge run in price, but the active addresses aren't really meeting our expectations, you might think then that, hey, this isn't right, and the model will point it out for you. Or is the value of the stablecoins on the sidelines, is it matching with the price move? And if it's not, then the model is going to attempt to point that out for you. It's combining these two metrics in order to say, based on what active addresses are doing and based on what stablecoin dominance is doing over a range of time, what is the price doing? And does the movement in the price make any sense? So when we add the price movement in, then we see that there are points in time where this metric is white. White means everything's kind of in line with expectations, right? As we're moving through, you'll see the majority of the time, the metric is going to be white. So there are going to be these times where the price gets out of line with what the metrics are telling us. And remember, the data isn't going to lie to us. The data is what it is. You're going to hear FUD and hopium and hype and, every flavor of misinformation on Twitter and on a lot of other channels. Not all of them, but a lot of other channels are going to be, telling you things that have a very clear motivation behind them. Data doesn't have a motivation. It just tells you whatever's happening. It just says what it is. Let's just kind of start from the beginning, and we'll just quickly run through this and talk about how this metric has worked in the past, and then we'll show how this could be worked in conjunction with other metrics. Let me start by saying this metric, it shouldn't be the primary factor guiding your investment strategy. This is more kind of the macro picture fundamentals behind the crypto market. It's going to be confirmatory for you, right? So if one of your metrics is telling you, hey, this is kind of what it's looking like, you can then confirm if the actual fundamentals underlying what's going on are sort of matching up with your beliefs. So let's take a look. So in 2019, we see that this gets above this orange line. That's telling you that the movement in the price has become out of line with what we're seeing in the risk metrics, or in the metrics that the risk model is using to assess movements in price. So it says we're out of line and we very likely are going to need some type of pullback coming. And so we'll just mark that here. We're out of line and we're going to need some type of pullback. And that's exactly what happens. We start to correct off of this point. So we hit a price of around 12.6K, and then we correct all the way down here right at around 7.6K. So we come down off of this level at around 13K or so in June of 2019, and we correct down, and then we start to show some signal saying that, hey, maybe we've corrected too much. But notice that it's very weak, right? It's just on the border and it's not really telling you anything significantly. It says, hey, maybe we've corrected too much, and we do get a price bump. We go from 7.7K all the way up to around 9.5K. But then the COVID capitulation event, and you get a very clear, sharp, peaked channel, right? We drop below this channel and you get this sharp peak. That is a strong signal. That is actionable information. So it says, hey, we've come down way too far, way too fast. And the price needs to go on a run because this isn't matching up with what the metrics are telling us. And sure enough, the price goes from around 5K at the bottom of the COVID capitulation event, and we go on a huge run. We go on a run all the way up to here where we get another weak signal. So we're at now 12.2K or so. We get a weak signal and we do get a correction. Notice even with these weak signals, there tends to be a move to the opposite side coming very soon. It just may not be like a large move, a long-term move. But we then start to see extremely high signals. So this starts to tell us at around 30K or so. It starts to say, hey, the market has gone up way too far, way too fast. And sure enough, we go from 40K right here in January all the way down to around 30K. It resets, and then we get ready and we start to go on our next run. And we go all the way up to, we all know what happens there, 64K. Now, once it starts signaling to you that this market is way too overheated, remember, you have to put this in context. This is the middle of a wild bull run. So when you're seeing the price up here at 64K, you have to imagine that a bull run can last for months at a time, right? The market can remain irrational for long periods of time. And that's exactly what happens. We kind of, even though this has told us now twice with two very sharp high signal peaks, it said, hey, this market is way too far gone. It was, but it just took until around here at the end of April going into May for the market to see our real correction. And of course, we have this May correction. Elon Musk tweets, China bans Bitcoin, we all know. And in June and then into July, it's telling us, hey, this market is way too oversold. The active addresses, the stablecoin dominance is not in line with what we're seeing with the price. So this is anywhere from 36K down to around 30K. And it's saying, hey, you should get into the market here because this is way too oversold. And what happens? We go on a massive price run. So we go from 36 to, anywhere down to 30K, all the way up to 69K. And what happens then? It tells us right here. It says in October, right here in October, the end of October, when we are sitting at 65K, this metric says, guys, this move is way too big. We need a pullback now. It's not matching with what the metrics are telling us. And sure enough, we go on a large downtrend from here. Now, you'll notice that all through 2022, you're going to get some smaller signals. Like you're going to get one here, a very small signal. You get it there, and you go on a big price run. You get another small signal here, and you go on a big price run. So, we went from 35K up to around 48K eventually. So even these small signals are telling you that something's happening, and whatever has happened over the last week or 2 weeks or 3 weeks, it's been out of line with expectations for what the metrics are telling us. Because remember, these metrics are ultimately guiding the market, right? The market is just a derivation of the number of dollars and the number of investors. So when we have these metrics, it's really telling us what's going on. At the moment, this metric is telling us that we are currently in a place where the price may be mildly overbought. Okay. And so a pullback could be expected. And I think a lot of people wouldn't necessarily disagree with that we could at any time see some sort of pullback because, we have gone on a fair price run. We are up from around 16K all the way up to around 29K. So nearly a 2X over the last couple months. Really since January, we went from 16.6 up to where we're at now. So the model is telling us at the moment, a pullback could very likely be expected to occur. And that wouldn't surprise me one bit if we were to pull back from here. So I think that this metric isn't something you're going to want to run out and try and trade with. But I do think what it can do for you is help you to look at what's going on with this metric and correlate it with what you're seeing in other metrics. Currently, I don't have this metric ready for release yet. I'm going to try and put this up on polaritydigital.io, but I'm going to need to get access to a few other types of metrics before I'm able to do that. So, hopefully within a few weeks, I'm going to have this up there. But what I'll do is I'll try and show this, anytime any significant change occurs. But what we'll be doing for right now is watching what happens with this right here, because currently it's signaling to us that we're a bit overrun and are going to need a pullback. So it's going to be interesting to see how this plays out from here. So with that said, guys, if you guys like this type of content, don't forget to hit like and subscribe. And until next time, as usual, see ya.